Hey guys, what's up? Welcome to a brand new video. Today we're going to talk about price action. Price action, price action, price action. This will be the only video you will need on price action. I'm going to tell you everything that I know and everything that I use in order to confirm my bias and in order to take my trades. Let's get into it. Okay, so the first thing I want you to do, the first thing I always do is I make a top-down analysis. What is a top-down analysis? A top-down analysis is when you start your analysis at the higher time frame and you work your way down. So in our case, this will be the daily, the 4 hour, the 1 hour and the 15 minutes. This will be our top-down analysis before we get to the next part. You can also go even higher to the monthly and the weekly, but I assume you kind of know the direction of the market, and that is more determined by fundamentals, so by the news and everything that happens in the world. So we will be focusing on the daily, the 4 hour, the 1 hour and the 15 minutes. Let's get into the charts right now. So I'm on Euro USD. I'm just taking this chart as an example. So you have your top-down analysis and we have the daily. So right off the bat, the daily, what do we see? We see Euro USD was in a decline. Euro USD was going short. But what happened? Right here, Euro USD did something else than the trend was doing. So this is something I'm also going to talk about in this video. Trend lines, trends, how you can see if they shifted, how you can see if something changed to the trend, and how you can see if it is a market structure shift or not. So what happened? Euro USD broke this trend line. And trend lines are a bit of a meme in the trading community. I know that because everyone hears about trend lines when they just start out with trading. The first thing they learn is trend lines and support and resistance. But guys, we are also like obsessed with these smart money concepts and with the next level trading, the next new thing in trading, that we forget that this works. This just works. I just went back a little bit to the left. We have a trend line right here, and right here we see that EU breaks this trend line and it reverses into a downtrend. Guys, don't sell yourself blindly on this. This does not always work. I personally never use trend lines, but it is just something to keep in mind. Right here again, it breaks out and it reverses afterwards. It is just something to keep in mind in your head, and if you are more experienced with trading, you will see these trends happening in front of your eyes without using a trend line. So that's the point where I'm at right now. I don't need a trend line to see what the trend is, where the trend is headed, if we broke structure or everything like that, but a trend line can help you to do that. More on that later. Euro USD broke this trend line. That's not the only thing we broke. Our last swing high is broken right here. So we have a break of structure. What happens is very important. The next thing is that our next high was also being broken. So EU is right now looking very bullish. Before I saw this happening, I was very bearish on EU because I thought what we were going to do is to take out these highs right here and then go short. But news determined otherwise. That's a very important thing, guys, that news is going to determine the market direction, and don't let anyone tell you otherwise. Yes, I also believe that most of the market is like algorithm driven and everything like that, but you can't deny the fact that big fundamental news events really shift the market and determine the place the market is headed. Now this happened because the inflation in the US was lower than expected and it is going down. So analysts may think we have peaked in inflation, and when inflation is higher, that is usually good for dollar, because the dollar is going to be more worth. That's the simplest way to remember it. So now the inflation is going down and the dollar is also going down with it. What happens when dollar is going down? Euro USD is going up always. Dollar and Euro USD are inverse correlated. So that means when dollar goes up, Euro USD goes down, and when Euro USD goes up, dollar goes down. But it all has to do with the dollar. So back to our daily bias. You always need to find out where the market is headed, and you have to base your trade around that. So where would the market be headed right now, and where is the best place to potentially trade? As you can see right here, these are the only highs that have not been taken out yet. Also, it is a support and resistance area for me. But what can we expect from the markets? We can expect to go to this level at least, or to maybe even go higher. Then we can expect a bounce on the support and resistance level and go even higher than that. Or we can expect to go over here, create an overlap, come down, retest this level again, and come back down. Always remember that you can't fixate on the direction the market is headed. Euro USD doesn't have to go bullish another 300-400 pips. Euro USD can just create an overlap, and go down. Maybe it even doesn't do that. Maybe it goes down directly when market opens on Monday. But your job is to find a setup with the best probability in order to make money, and that's the only thing you need to do. You are not a market analyst, so you don't need to see if your USD is going up or down. You're not a banker or you're not involved in news or anything like that, so it doesn't matter if it goes up or down. The only thing that you need to do is to find the best place to sell or the best place to buy. That is it. Before I continue our top-down analysis, and this is basically the top-down analysis for the week ahead. So before I will continue with this, I'm going to tell you everything about price action and everything that you need to know before I can continue with this top-down analysis. So the next thing that we need to talk about is the trends. I've talked about this briefly earlier, and it is about the trend lines, it is about the trends, it is about the current trend and the direction we are headed. So if we go to the 4 hour, the 1 hour, the daily, it doesn't even matter. We always have a trend. We have an uptrend, we have a downtrend. So you're bullish or you're bearish. What can we see in this area right here? This is the 15-minute on EU. You have an uptrend right here. So our recent trend, our current trend is an uptrend. You have a downtrend right here. Our previous trend on EU was a downtrend. You have an uptrend right here. Downtrend / consolidation right here. Downtrend right here. Uptrend right here. Downtrend right here. A long consolidation zone, an uptrend right here, a long consolidation zone, and then again a downtrend right here. So what do you notice when I'm making these annotations? When there is a downtrend, we have a consolidation zone. After that, we have an uptrend. After that, we have a downtrend. We have a consolidation zone. We have an uptrend, but this uptrend actually goes to here. Then we have a consolidation zone right here. Then we have a downtrend right there. After that, we have a consolidation zone again. Then we have our downtrend up till here. Right here, we have a small consolidation zone. Then we have again our uptrend. Then we have again our consolidation zone. Then we continue our uptrend. After that, we have our downtrend when there was a small consolidation zone up here. Then we have a consolidation zone right here. Maybe we can consider everything of this a consolidation zone. We have our uptrend. We have a consolidation zone, we have a downtrend, we have a consolidation zone, we have an uptrend, we have a consolidation zone. I think it is clear what I intend to say. It is you have your trend, your consolidation zone, your trend continuation, or your trend reversal. So you have your uptrend, you have a consolidation zone, you have a downtrend. You have a consolidation zone, you have an uptrend, you have a consolidation zone, you have an uptrend, you have a consolidation, you have a downtrend. There is always this consolidation zone. And that is really important because you don't want to trade that consolidation zone. You want to trade when price breaks out of that consolidation zone, and that is the best area to trade off. Then the next thing is sessions, trading session. Really important that London opens at 9 a.m. New York Forex market opens at 2 p.m. and the New York Stock Exchange opens at 2:30 p.m. Why is this important? When more markets open, and these markets are markets that have a lot of traders and a lot of banks and a lot of institutions on them. So what does this mean? A lot of volatility. When you have a lot of volatility, you can create trends. You can create market directions and you can create big up moves or big downtrends. When there is consolidation, there is not a lot of movement in the market and there is not a lot of volume in the market. The market is indecisive. The market has almost as much sellers as buyers. So it is not moving anywhere. It is just going sideways. And that is what happens here. The market is just going sideways. Right here. It's not a good place to sell and it's not a good place to buy. So when the market is consolidating, it is collecting orders. It is collecting orders in order to go short or in order to go long. And then when orders get filled, the market will go down and people will jump on the back of that, will also sell their positions or will also buy the positions. We create a pullback like this. And this is because not everyone sees the picture the same way. Some people think EU is a sell, some people think EU is a buy. And that's not only for retail traders, but it's also for like big institutions, for like big banks. And everything that happens in the world affects this price. But in theory, that doesn't really matter because we only want to catch a part of the trend. And we already know where it is heading because of our daily bias, or at least that is our bias. And then I would advise you to pick a session and only trade that session. Or maybe two, maybe London and New York. I'm fortunate enough to live in Europe where I can trade London and New York during the day. But if London is like midnight for you, if that's your lifestyle and you are okay with that, you can trade that, but you can also trade New York. I would not advise you to trade Asian. As you can see, these consolidation zones mostly happen in the Asian session. So right here, after that, New York is closed, up till that London opens, there's no volume in. Here when New York is closed, up till London opens, there's no volume, and so on and so on. You have to think by yourself, the biggest banks in the world are located in the US and in Europe. The banks are open from 9 to 5. They're not going to trade overnight. So that's why there's no real volume in here. And guys, I'm just briefly talking about everything about this. If you want to know something more in depth on these topics, you have to ask me and I'll make separate videos about that. But this is just understanding market flow and just understanding why the market does the things it does, and that is very important. Now the next thing I want you guys to notice on this chart are gaps in the market. As you can see right here, we have a gap. This is a gap where price hasn't filled any orders. It just went straight through this area. So a lot of people believe, mostly thanks to the big trading YouTuber ICT, is that this is a fair value gap, and a fair value gap needs to be filled. A fair value gap will be laying with orders and the market will react to this. As you can see right here, market instantly reacts to this area, but that's not enough and it goes further down. Market is heading short, and if it is heading short, you can't do anything about it, even though this is a fair value gap and it needs to be filled. But the most important thing is that it gets filled. Right here, we have a new area, fair value gap right here, this. And as you can see, price fills this, or better said, fills this candle, and it went straight back up even higher. Keep in mind that this is a 15 minutes, and I use this technique to enter my trades, but I use this on the 5 minutes, and I combine it with a lot of other things. But I hope you can see, and I hope you can realize that market gaps need to be filled some way or another, and it doesn't have to be right now, it doesn't have to be this day, it doesn't even have to be this week, but they will get filled sometime. Because the market always needs to be in balance, and if it has these gaps in the market, it is not in balance. So actually, this is like the real gap, the biggest gap that has not been filled by price. So as you can see, price comes right here, fills this gap to the T, and it reacts immediately. Then we go further. We have here our biggest gap yet. This is a trade I took actually, and this was the gap that I saw, and I took EU short up until this gap. So this was the gap. Price has balanced this area, price has balanced this area, but price has not balanced this area. So price needs to fill this area. So we came right here into this area, and what happened? We broke these lows. And as I said earlier, once we are consolidating, we want to see it break that consolidation. So right here we were consolidating, and it broke this consolidation zone by breaking these lows. So I knew, okay, we're continuing our current trend, that is going short. So we went short, and I took my trade around here. As you can see right here, if I zoom in, here's another gap in the market. What do we know right now? Gaps need to be filled. So I place my order, I place it around here, I place my stops, unfortunately, above the imbalanced candle. And yes, a lot of people, I've also posted this on my YouTube, and a lot of people were saying like, why didn't you place it above the swing high? And that's quite stupid of you, and why not above the order block, everything like that. I know it would have been much better to put your stops right here, but that is my edge. My edge says you have the imbalanced candle, 1.5 pip above this, and that is your trade. Why do I do this? So that I can keep my take profit as low as possible, and I can get in and out of the trade as soon as possible. But yes, this is something that I will maybe try and backtest and see if it is really improving my edge or if it is not. If it would improve my edge to put my stop loss above the swing high every time, I might switch to that. So that is my trade. My trade was right here, and it is also in my London session, as you can see, 9:45 AM. And then my take profit will be at the low right here. So let's say potentially I did take this trade the correct way, and we put our stop loss above here, our take profits under here, and we have a 3.5 hour trade that is perfectly executed and take profit taken to the T. And since I started using this technique, looking for gaps in the market where I can take my trades from and to, that my take profits get hit to the T, like to the T, and reverse all the way back up. And that's the same what happened here. It reversed all the way back up. Right now, as you can see, another gap right here in the market. It came up, it came down quickly. So what happened when news came out Wednesday? It went up quickly, and it took out this high. That is the next thing that I'm going to talk about. That is liquidity. Liquidity into the markets. What is liquidity and why is it important? The liquidity in the markets is the place where your stop loss is laying down, where your stop loss is put at. But not only your stop loss, all of our stop losses. So let's say you took a short right here. You took a short right here, bam, and you put your stop loss around here. I don't know, you put your take profits maybe even further down because you know, okay, he was probably going to this level or something like that. I don't know. Probably a lot of people took this trade. Maybe took it in some way of this, it doesn't matter. They put their stop loss around here. Because why? We've been taught, put your stop loss above the swing high. That's the same thing with what I should have done here, but in most cases it won't even matter. As you can see, what happens? Price hunts this area. Price hunts this area so that all of your stop losses get tapped. Stop losses get tapped. Once more, stop losses get tapped. The guys that were short from even here. And this is for like swing trade positions, but you have to imagine that you don't mean anything in the markets. Your position isn't worth anything in the markets, and they're not hunting you. They're hunting big institutions, big companies, because they have a lot of money into the markets and they are chasing big positions. So what happens when price takes out all of these stops that were short from here, it collapses down immediately. It collapses down immediately. And let's go to the price action of today actually. As you can see, or this was yesterday, this candle, this very, very big imbalanced candle has a very, very big gap in the market. So what do I think was going to happen? That price was going to create an overlap right here, and then it will come back to this level, and then it will go back long up to this level or go long beyond that. But this needs to be filled. One way or another, maybe it is next week, maybe it is next year. This gap is going to be filled. Okay, but I was talking about liquidity. And liquidity are zones where you would most likely put your stop loss. That is liquidity. Right here is a perfect example of a liquidity grab in the markets. This was a big consolidation zone. With a big consolidation zone, there are most likely a lot of stops. Where are the stops laying down? Around here and around here. Above the highs and on the lows. Price takes out the lows a lot of times. Right here, right here. Price takes out the highs a lot of times. Right here, right here. And then something remarkable happens at this moment in time. If you would go short, you would put your stops maybe here, above these highs. But some people would even put them above these highs. That's the most smart thing to do. Price knows this. So what does price do? It goes up above these highs, it takes them out, and then it immediately collapses. Collapses down, and where does it collapse to? Underneath all of these lows. And a lot of underneath it. So everyone that was long in here and that had a stop loss underneath this area was stopped out 100%. So your position gets bought by someone else. So a lot of money is coming back into the market and the market flies up. So how can you trade around this? Notice these things in the markets, backtest this, and just notice when price does this. Notice where price does this, and then you can maybe anticipate this. So let's say you see this happening in the markets. Okay, you know we're going long. Okay, we took out all of this liquidity. Bam, that's first thing. Then the second thing, or gap. We have a gap right here. Bam. I'm sorry, my camera fell out. How can you trade around this? As you can see, liquidity has been taken out right here. Liquidity has been taken out right here. And we were very impulsively going long. So what are we going to do? Most likely, we are going to continue long because that's where the market is headed. That's where all of this bullish momentum is headed. But banks and institutions are not going to buy up here. They want to have a discount price. They want price to be cheaper. So you can have your discount right here. This is also something that ICT teaches, a discount price when price is underneath 50%. So basically when you have your trend from 0 to 100, when price drops 50%, that is where you buy it. This is like the Fibonacci method, but a bit twisted. So you can use this. These are my settings, by the way. And you can use this to your advantage to put up a nice trade. So let's say price is coming down. You put your long position underneath the 50%. You put your stops underneath the gap right here. You put your target up to your 0, so up to your highs, and you have a very, very, very nice trade with almost no drawdown. And how did we make this trade into a winner? By knowing where the market is headed, by taking advantage of the gap, by taking advantage of the discounted price, and just seeing this impulsive move into the market after liquidity been taking, knowing that we have to go long. The probability is the biggest to go long after a move like this. Then something else that is very nice in the markets, that are order blocks. So the most easiest way to explain order blocks, in my opinion, is you have a downtrend, you have a small uptrend bullish candle or two, and after that the market just collapses. That is an order block. I'm going to give you an example. I'm going to give you an example right here actually. So you have this downtrend, it's starting to happen a downtrend, you have an uptrend bullish move, these two candles right here. I also count this candle because after this candle it just collapses. You take this down to here, what can you see? Price comes up into this order block, you put your stops above this order block, you put your TP underneath the consolidation zone because you know price is heading for liquidity. Bam, you have a 1/6 trade. I'm going to give you another example. Right here, this is your order block. As you can see, price comes back into this area and goes short immediately after that. And there are a lot of ways to draw on order blocks. If you want to see more of this, you have to search on YouTube because everyone draws them on differently. And this is just how I draw them on. The two candles that go the opposite direction of your trends before you collapse, that is the order block. But again, everyone draws them on differently. And as you can see, again, a very large, nice trade. TP underneath the previous lows because you know price is heading for liquidity, and bam, you have your 1/6 trade. And by the way guys, it's not only in a downtrend, I'm just a bearish trader, so I always see these downtrend moves. It's also worked in an uptrend. Right here, it is before the biggest move happened in the market and the trends. You have your two candles before the trend exploded. You put it right here. As you can see, price went into this area. You can put your entry right there, your stop loss underneath the order block. Then it is very important that you always realize where market is headed and that you always realize the bigger picture. And as we know, this is going short. We broke this low right here. We had an impulsive move downwards. So the probability is higher to go short than the probability is to go long. So always keep that in mind. And what can't happen if you are favoring short? You can't happen price to break this. And I'm going to tell you something else. You can't happen price to break that whole order block. Because if it breaks this order block will be invalid and price will have a market direction shift. So price will continue going long in this scenario. So what is the most safe thing for you to do? Of course, price could break this. That could be a possibility, but we don't trade with possibilities, we trade with certainty when we want to have our money back into our account as soon as possible. So we put our take profit at this order block for a 3.6R, and that is just the safest trade you can do. And then again guys, another last example for you guys. This is your order block right here. As you can see, price comes in here, but we're not only trading the order block, we take everything into perspective. This is our order block. This is the gap that is into the market right now. This whole area is the bigger gap. You need to understand that the gap is not only like this candle, for example, because I know, yes, this is a gap. I can see that, but this is also a gap. On the 1 hour, the 4 hour, maybe it doesn't matter what time frame. There will be a time frame that this will be like this, a 1 candle gap. And that is very important to realize that this is the whole area that has not been filled. So this is the whole area where you could take a possible trade. Then the next thing, we want to see a discount. So we want to see it underneath 50%. So we're only searching right now, right here in this area, underneath the 50. Underneath the 50, we're searching for entries. Then what is our entry saying? Let's say we take this order block right here. This is our order block, this candle and this candle. Then it is very simple. The top of the order block stops underneath the order block. Take profit above liquidity, that's right here, and you have a 4.6 trade. Guys, price action is very simple if you understand it. I think it is very important for you to double down on this, that you really understand this, and that you can read price action like it is nothing, that you can see these order blocks happening, that you can see which direction the market is headed, that you can see where liquidity is laying, that you can see where a discount is in the markets. And then the only thing that you need to master is your psychology. Psychology is the most important thing. I'm praying for this and I hope everyone understands this. Psychology is the most important thing, and if you master that, you will be successful in trading. But price action, you must know this like it is This is like the fifth grade education for traders, like the beginning stuff. You need to know this. You need to know all these beginning stuff, and then you can work on your psychology. Of course, there are a lot of edges in the market. There are a lot of plays in the market. There are a lot of strategies in the market. Just choose one, double down on this, and you will be successful. Guys, what I want you to do is that I've handled a lot of topics in this video that I think are the most important ones. I want you to choose one or choose two and search on YouTube everything that you can find about that. Everything that you can find about order blocks, everything that you can find about gaps in the market, fair value gap, everything that you can find about support and resistance, trend lines, it doesn't matter. Search one or two things, backtest them, try to combine them, work them into your own strategy or create a strategy around that and try it out for 3 to 6 months. Try this out for 3 to 6 months on demo, on backtesting, doesn't matter, and I will guarantee you, you will 100% be successful. If not, it is because of your psychology. I've just shown you, like, it is so easy to catch these trades, and I know in reality it's harder to catch these trades because they're not formed live yet and they're creating it in front of your eyes. But that's the most beautiful part about trading. You can see these moves happening. You can see why the market does things and how the market is handling things. That is the most beautiful part about trading, in my opinion. Okay guys, we have handled all the blocks, we have handled our daily bias, we have handled liquidity, we have handled all sessions, we have handled everything. The last thing that I want to do is to handle this top-down analysis with you guys. So we were on the daily. So our plan is that price needs to take out this liquidity zone, or it just needs to react to us. Then the 4 hour, what can we see? We have a gap right here. Bam, we have a gap right here. We probably have liquidity underneath this area. And I'm so sorry guys that I don't have names with these boxes and everything. Most of the time I really don't draw on my charts. I like naked charts. I don't like a lot of annotations on these charts. That's why I don't draw break of structure or change of character or everything like that. I just leave it blank like this, and that's how I like it. Then we go to the 1 hour. What can we see? Not a lot of difference. So what do I expect the market to do? I expect the market to go up a bit more, to take out these highs preferably, then to come back down to this area right here. And keep in mind guys, this can be happening over 2 days, 3 days, but it's also going to be happening over a week. Come down to this area. This is also a very good support and resistance area where price likes to react to, and then give a sort of a reaction and then continue down or continue going back up. Remember, it is not a task to predict the market, it is a task to catch trades in the market. Guys, I hope you enjoyed this semi-long video. I hope you learned something from this. If you like to see more of these kind of videos, please let me know in the comments down below. Subscribe if you're new, leave a like. This video cost me a lot of time to make. And yeah, I hope to see you in the next video. Bye bye guys.